Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday 20th June 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Switzerland Corporate Sales FX. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek. Thank you very much for taking your time to speak to me and our listeners.
And you, Simon. Good to talk.
I'd like to start, well, it's been a common theme recently, but geopolitics. I mean, it's ramped up a bit this week. Obviously, particular focus on Iran, a little bit of a change, I guess, in rhetoric from the US side.
Yeah.
So maybe you could talk us through that first of all, the scenarios, market impacts. And there's been fairly limited fallout in the market so far. So what's your take on that?
Yeah. I think limited fallout so far. Like we've had, the main contagion channel is obviously crude oil. We've had I think it was about a 10% jump earlier in the week. We've retraced some of that with this de-escalation and this potential 2-week window that could open up some scope for negotiation. And I guess given where crude oil was prior to this kicking off, that's just not big enough a move to warrant a more substantial move in treasury yields and a notable move in inflation expectations that lifts global yields and therefore feeds into hitting equities more. And therefore, what you really need, if this is going to broaden out into a wider financial market episode, you probably really need a much bigger move in crude oil. And in that context, we had the IEA monthly report this week. And the other point to make is that essentially the macro global backdrop for crude is pretty bearish. We've had a build-up in inventories in recent months. The IEA now predicts peak oil demand from China coming earlier than they previously anticipated. And essentially they've described the outlook as crude being well supplied on the global market. So I think that in a way probably curtails the appetite for certainly speculative buying on the geopolitical risks until it's very evident on a particular eventuality. And really, therefore, we just have to wait and see. Like, we've got roughly, you could sit here and probably come up with 10 scenarios, but very rough 3 scenarios, a continuation of the current bilateral firing of missiles with no real change in that. And then perhaps over, a 3-4 week time scale, Israel then feels enough damage has been done to their nuclear facilities to pull back, and we get a kind of a gradual de-escalation. The second scenario is, of course, the US get involved and they attack the Fordo nuclear facility, and then they're out. They again, like the MAGA movement in the US, are so ideologically opposed to foreign wars that I think if the US do get involved, it's very specific with a very clear strategic goal. They get in, they take out the nuclear facility, and then they're done. And then a kind of a subset of that scenario is either Iran retaliates against the US or it doesn't. Is Iran really going to get involved militarily in a conflict with the US? Because if they did, then you're talking about the potential fall of the regime. And I think the ultimate goal here is the regime to survive. Yeah. And therefore, I think it's more likely on the second sub-scenario of that essentially, you might get a symbolic attack here or there, but nothing major. And then you get possibly in that scenario a faster overall de-escalation. And then the third one is regime change. Yeah. And again, I don't think the US gets involved in that. Of course, we all know the history of US involvement in regime changes in the Middle East is not particularly good. And again, it potentially draws in the US into a longer term scenario, which again, going back to the MAGA movement point, I don't think is something the Trump administration would have much incentive for. Of course, Israel wants regime change, but can they do it without the US? I don't think so. So all in, that subset of the second scenario, where potentially you get a fast de-escalation if the US does go in and is strategic and precise, that could be what culminates. Now, obviously, you'd get a spike higher in volatility, you'd get crude going higher, but it could then reverse pretty quickly. And it's all about treasury yields in terms of feeding it into the dollar, unless if you got a big equity market correction, but that would be because US Treasury yields jump quite higher, and then the dollar would obviously be bid. The difference for something like dollar yen is that if you get higher yields in the US without an equity market correction, then you argue dollar yen goes higher. Mm-hmm. But if you get a very sharp move higher on crude that starts to result in asset price corrections, I would argue that the inflation link breaks down and actually dollar yen would go lower. So dollar yen's a bit more mixed, and that might be why we're not seeing, sizable moves. Yeah. All broadly in dollar, but certainly in dollar yen.
Well, maybe that's a good segue actually into one of the other points I wanted to cover today, the BOJ and yen and JGB steps that were taken this week. I mean, what's your thoughts on that?
Yeah, I think first and foremost, this was expected. So I think there'd been, we had the minutes of the BOJ's meeting with market participants released a few weeks ago, which highlighted the main feedback on the pace of reduction in JGB purchases was this idea of a 200 billion reduction. So that is exactly what happened. So I don't think that was a big surprise. We've also then today had the MOF issuance plan changes, which was larger than expected, 3.2 trillion in terms of reduction in 20, 30 and 40-year issuance. And then instead, you're going to have an issuance increase in 2-year, 1-year and 6-month bills, with overall issuance actually coming down by 500 billion yen. So that was a bit larger than expected, but those two measures, I think all in, maybe the MOF a bit more than was anticipated, but generally the markets had already positioned to start expecting this, and that kind of addressing of the problem of this supply-demand imbalance. And if you look at the flows from abroad, that's another indication that I think investors were expecting this. We had a huge buying by foreign investors into Japan bonds in February, March, April, a record 3-month buying period. And then you had modest selling in May. So from record buying to modest selling, a really big shift in the foreign investor flow, which I think certainly was part of the reason why we had that jump in long-term yields in May. And the weekly data is showing us that over the last 3 weeks, foreign investors have gone back in. They've bought about 1.8 trillion worth of Japan bonds. So again, foreign investors may be coming back in because they felt what's happened this week was going to happen. So all in, it hasn't had a big impact. There's been a slight flattening of the JGB curve, 2s, 10s, 2s, 20s and 30s, but nothing significant. As I said, I think overall it was expected.
Yeah, okay. Any other key events this week? Obviously, the central bank meetings. We had Bank of England, SNB, but obviously in focus, obviously the FOMC kept rates on hold again, and some negative rhetoric out from Trump again against Fed Chair Powell. What was your take on that?
Yeah, indeed. I think I think the markets are kind of used to it now already. So, although that could come back as a bigger feature later in the year, because all the Trump administration have to do is announce who they think they want to have as the new chair, and then if that person is willing to speak on the markets, historically that wouldn't happen, but with the Trump administration, that could very well happen, and that obviously undermines Powell's position. The markets start to listen more to the incoming potential chair, and it certainly is messy and not particularly positive for the markets. But for this week, probably Powell was a bit more hawkish than we had anticipated. We thought maybe he'd give more emphasis to the actual data, and the actual data was weaker inflation and some more compelling signs. Still not broad-based, but some compelling signs that the labour market is weakening. But instead, he kind of focused a bit more on the potential. Inflation is going to move higher, so probably unfair to call it potential, because It's, the tariffs have to come through at some point. But he was more focused on those risks rather than the positive of actual inflation coming in a bit weaker than expected. So the forecasts in general were kind of stagflation light, weaker GDP, higher inflation and higher unemployment rate. And really, I think Powell's hands are tied with both the geopolitics more recently, but also obviously the reciprocal tariffs, which are scheduled to go live again on the 9th of April, or sorry, the 9th of July. Like, it's incredible if you think of the way in which the administration were talking, I don't know, a month ago about all these wonderful trade negotiations that were going on and the deals that were going to be done, and nothing. We have this UK deal, which was like, pretty sparse. Now, maybe we'll be surprised and there'll be a bunch of deals done before the 9th of July. But if not, as we start to go into July, the markets are going to get nervous about, suddenly reciprocal tariffs are back, and they're back pretty much as they had been announced in April. So we could certainly get some pickup in inflation expectations and volatility related to that. And I would imagine, obviously, putting geopolitics in Israel Iran to one side, that dynamic is definitely dollar negative.
Yeah, plenty of uncertainty around geopolitics and a tariffs to keep us all busy in the next few weeks, I think. Thank you.
Indeed.
Thank you very much for your thoughts, Derek, and have a great weekend. Thank you.
Thanks, Simon.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.